Estimating bad debts expense. Estimating bad debts expense is not like looking into a crystal ball. There are methods that accountants use to estimate it. There are two main methods of estimating bad debts. The credit sales method, also known as the income statement approach, which is pretty simple to calculate but not that precise. The other method is the aging method, which is also known as the balance sheet approach. This method has more complicated calculations, but it is more accurate. I'll explain both methods. Here I'll explain how to use the credit sales method to estimate the bad debts expense. Assume that a company sold to a group of customers for $1 million on credit. The company would multiply the credit sales by a certain percentage of estimated bad debts expense based on its previous experience. So let's assume that the company's previous experience indicated that the bad debts expense is about 3% of the credit sales. This would make the estimated bad debts expense for that company 1 million times 3%, which is equal to 30,000. The entry to record the bad debts expense would be to debit the bad debts expense for $30,000 and credit allowance for doubtful accounts (AVDA) for the same amount. As mentioned earlier, this method is pretty simple as it is based on simple multiplication. But why isn't it accurate? Assume that the company's customer mix this year was as follows. The percentage used might be good. But what if the company's customers mix changed to be as follows? Most probably, in this case, the percentage of bad debts expense would be wrong. Since the company does not have a static customer mix, this method wouldn't be accurate as the percentage used in the estimation is based on historical experience, which is based on a customer mix in the past. The aging method to estimate bad debt expense relies also on credit sales. However, it will judge if a customer is good or bad based on their credit history with the company. If the customer is paying the amount due on time, they are regarded as good customers, with low risk of not paying. However, a customer who postpones payment has a higher risk and hence is not regarded as a good customer. The more the delay period, the more the risk of the default. Let's illustrate. Assume that the company sold goods for customers with terms of payment within 30 days. At the end of the accounting period, only 15 days passed since that sale. The customer is not supposed to pay yet. Previous experience indicated that only 1% in the category that falls within the due date defaults. Now let's assume that the company sold goods for customers with terms of payment within 30 days. At the end of the accounting period, 55 days passed since that sale. The customer didn't pay, so this amount is overdue and the customer is delaying. That is a more risky customer. Previous experience indicate that only 10% of customers default if they fall in the period of 2 months after the due date. Now let's assume that the company sold goods for a customer with terms of payment within 30 days. At the end of the accounting period, 82 days passed since that sale. The customer didn't pay, so this amount is overdue and the customer is delaying. This is even a more risky customer. Previous experience indicates that only 20% of customers default if they fall in the period of 2 months after the due date. Now let's assume that the company sold goods for a customer with terms of payment within 30 days. At the end of the accounting period, 113 days passed since that sale. The customer didn't pay, so this amount is overdue and the customer is delaying. That is an extremely risky customer. Previous experience indicates that 40% of the customer default if they fall in the period of 2 months after the due date. Accordingly, customers are classified based on the time period since the sales transaction. Companies have various classifications. Some companies would categorize the period into the first 30 days past due, then the second 60 days past due, and so on. Others could choose a different classification. Let's assume that the business chose the classification in the table presented here. Customers are then analyzed to see whether their balance is not yet due or past due, and if it is past due, then which category would they fall into. The accountant prepared the analysis and it looked as follows. What do you think of the credit department of this company? I believe it's not doing its job. Look at customer A, for example. They owe the business amounts that are not yet due and past due in almost all categories. This means that the business credit department knew that this customer is not paying and still approved additional credit to them. The same applies for customer B and C. The total of each category is then added. Based on the company's previous experience, it would put the estimated percentage of defaulting for each category as follows. The expected default in each category is calculated by multiplying the total of the category by the estimated default percent as follows. Then, the total expected default is added together to represent the new suggested estimated balance of AFDA, $180,000 in this case. Let us further assume that the business had a previous credit balance of AFDA of $20,000. The suggested estimated balance of AFDA as per the calculation in the table is $148,000. We need to add an amount to the $20,000 to make it equal to $148,000. This amount is $128,000. So we will debit the bad debts expense for $128,000 and credit AFDA for the same amount. When this amount is posted to AFDA, the new balance will be equal to $148,000. Let us assume that the AFDA had a debit balance of $15,000 instead. The estimated balance of AFDA, as previously mentioned, is $148,000. So we need to bring the balance of AFDA to this amount. If we added $15,000 to the credit side, the balance will be equal to zero. But this is not what we want. We need it equal to $148,000. In this case, we are going to add $148,000 to the debit balance of $15,000, which is equal to $163,000. The entry would be to debit the bad debt expense by $163,000 and credit AFDA for the same amount. When this amount is posted to the AFDA account, its balance will be equal to $148,000.